a great way to start
Yeah.
as soon as it goes live.
Cheers.
Cheers. Well, welcome back to the Investor Shed podcast, everybody. My name is Nick Beveridge. I'm the real estate investor guy, and I am here with our guest host today, my favorite guest host that I've ever had, Mr. Brett Shoemaker. Good morning.
Good morning.
How are you?
Pretty good. Pretty good. Good start to the year.
You guys might be wondering, where is Jeremy? Well, Jeremy has been fired. No, I'm kidding. He's not fired. He got cancer. He got cancer in his bitch tits, and he
I think he just
and he needs some time off. No. I'm joking about that. And he does not have bitch tits. Jeremy had a lot of appointments today, and he couldn't make it. Bless his heart. It's all good. We're gonna get through with Brett Shoemaker the best we can. It's okay. For the 7 listeners out there, you will be entertained. I promise.
It should be a good time. We miss you though, Jeremy.
We do miss you, Jeremy. I like to joke with Jeremy when he's not around. He loves it. Brett, it's a little chaotic right now in the world of like it always is. But I guess there's like new wars going on and stuff, and interest rates are like down and up and down and up. But for the most part, they're pretty low. Business is good. Tell us what's going on in the lending world from your perspective.
Yeah. So pre bombing Iran and killing the Ayatollah, interest rates had just hit their kind of 3-year low.
3-year low. Okay.
Yeah, so basically since, we pulled out of the pandemic in terms of rates, we'd gotten back the lowest that they've been essentially since then. The average conventional rate had dropped just below 6% for a couple of days.
Okay.
And then, then we bombed Iran, and usually bombing the Middle East is good for interest rates.
Come on, let's bring that back, huh?
Yeah, but not this time, I guess. The mortgage rates are tied to the 10-year Treasury yield, and those go up and down based on supply and demand. And so usually when things are uncertain in the world, investors and people with money buy the U.S. 10-year Treasury. And so the more people want to buy it, the lower it becomes. Which is kind of an inverse from a stock. You would think that the more demand there is, it would increase, but the more people want to buy treasuries, the lower it becomes. In this case, that didn't happen. People started selling them for some reason. So
people started selling their treasuries or their bonds,
and so then you have to increase the yield of the treasury to get people to buy it.
Okay. Any logic behind that you know of?
None that I am qualified to talk about. I don't.
Okay.
I could guess, but I don't know why.
Okay.
It just kind of happened.
So being a mortgage lender, in early 2026, what's the average payment that you're seeing most people agree to for just a regular, entry level type of house? If there are any entry level homes. On anymore.
I mean, in our area, so in northern Idaho, your entry level house is probably what, $400,000 to $500,000. I mean, anything under $400,000.
Yeah, in the mid 4s, I would say, for kind of an entry level house.
Yeah, and so if you're coming in mid 4s with a minimum down payment, which most first time home buyers do,
What's a minimum down payment?
Depends on the loan program. Could be anywhere from 0% if you're looking at a VA or a USDA. Could be 3.5% if it's an FHA. Could be 3% if it's a conventional loan. But generally speaking, somewhere between 0 and 5% is what first-time home buyers are putting down.
Okay.
And so if you're putting that down on what's called a 450 purchase, taxes and insurance, you're going to be pretty close to a $3,000 a month mortgage payment.
Okay. And how does that compare to when interest rates were at their highest? If you had to guess.
So, I mean, the highest average was probably 7.25%, and that was probably 18 months ago. I don't know. I don't have my calculator in front of me, but $1,250 a year per 100,000 more if it's 400. We're just doing some quick math.
Yeah,
it's gonna be about $5,200 more a year in interest. So that if you divide that by 12, that's about a $400 $450 difference just in
Okay,
interest rate.
so closer to the mid three, like almost 3,500 ish,
Yeah, I would say
$3,400
probably 3,400 is what you're
for
looking
an
at.
entry level home just a year and a half ago. So prices have gone down essentially almost $400 or $500 a month in recent times for an entry level home, which is I mean it's still a lot, $3,000 a month, but um, I mean what are the odds that it's just going to keep dropping?
Interest rates. So if you look like the 12 months, we dropped about a full percent in the last 12 months. I don't think you're going to see that again in 2026, barring some sort of um, significant event. I think towards the end of the year, it'll go down a little bit more. I think the consensus average for the people who use their kind of orb balls and predict like they know it's going to happen. They thought it would drop maybe another 0.25% from where we're at right now, and that's probably pretty realistic. But you know, the people who are waiting on the sidelines saying, "I'm waiting for 4% rates," you've got
keep waiting.
a ways to go.
And unfortunately, if you do just keep waiting, I'm noticing the entry level homes they continue to go up in price every year, even after the um, even after the interest rate hikes. The entry level market, unfortunately, it just keeps going up. And unfortunately, I've got a little insider information because I'm selling a development right now to some pretty large builders in the area. And the amount of money that they're paying per lot tells me that the entry level homes that they're going to build are not going to be priced where they are today. They're going to be a little bit more once those products come on the market next year or early next year.
Yeah,
So insider info,
yeah,
entry level homes, the prices may go up still, good chance. Interest rates may come down a little bit, but you can always, again, if you really want to buy a house and if you can afford it right now, there's always a chance that you could refinance your loan into a lower interest rates if rates do go down. But there's a good chance that will happen in the future. And there's also a very good chance that prices will just continue to go up in the future. Does that
oh
make
yeah,
sense?
yeah. Well,
And so that's why, we probably sound like salesmen. I'm a realtor, investor. You're the mortgage guy, but I think we can honestly say this is likely to happen. Is that the houses will continue to go up, the entry level homes, um, not just based on history, but also based on what I can see in the future, based off lots that I'm selling to builders, and uh, rates you always date. Apparently that's what they say. So like
yeah,
just lock them in, but you can always switch your
mhm,
rate. You can't switch the price of your house later.
right. Yeah, if you look at I mean, what it's supply and demand. What drives demand? Obviously, affordability, which is tied to interest rates. So as interest rates come down, affordability becomes a little bit more affordable, ideally, and so demand goes up. But then also things like 70% of the country has interest rates under 4%. Well, nobody wants to sell their house at 4% or 3% or 2.5% and get a loan at 7%, but they might do it at 5.5.
Yeah, I just spoke to somebody last night that refinanced she had a 2.9% interest rate into like a 6.8 or something
Yeah.
just to pull cash out.
Yep.
And I'm seeing that more and more where they're just going ahead, they're refinancing out of their long-term low interest rate debt into higher rates just to pull out cash because I mean, who would have thought? Who would have thought? But Americans have an issue with cash flow and they have spending problems and they always go to their house to rescue them with their equity. And they make some unfortunate choices long term based off the choices that they made on a daily basis, their spending habits. They get themselves into debt. So I used to think, I really did. I honestly believed 3 years ago that nobody's refinancing out of these or going to sell their homes at 3% interest rates. Like their payments are just too low. And now I see it all the time where people just don't care. They know they're in a good position, but they need cash or they want to sell. And they just don't think about how much money they're saving long term, or like, how can most people, I thought most people would keep what they have, but it sounds like most people are just whatever works for them in the moment, whatever is most convenient. You know what I mean? Am I going off on the rails there, or do you think?
I don't know.
Have you noticed anything similar?
I don't know. Yeah, I mean, I don't know the percentage of people who are committed to long term. I can tell you one of the things I see pretty regularly is somebody's got a great 30-year mortgage, 3.5%. But they've got $75,000 in credit card debt at 26% interest. And because their credit score is 665, their auto loan is 13.5%, and that's 50,000. And so one of the things I do a lot is calculate the blended rate, which is all your debts. When you average the interest rate, how much is your debt costing you?
Yeah.
And when you've got some of these higher interest debt, which, credit cards are just crazy. You've got 320,000 locked up at 3%, which is fantastic. But now you've also got 110 locked up at 21%. And when you average those together, this is costing you, I'm just making numbers up, but it's costing you 10% a year on the debt. You'd be better off pulling cash out of your house at 6% and paying that off than you would. But you can only do that magic trick once. You're kind of,
well, you can do it again in 10 years.
Well, yeah,
as you accumulate debt and and the price of your asset goes up.
Well,
and that tends to be the American dream.
Yeah.
Right. That's how people have survived. That's how your parents have survived. In case you guys don't know that. Not everybody obviously behaves this way, but it's a shocking amount. I'm super impressed ever since I've become an adult. I've always looked up to adults and I thought they were so responsible and everything. And then you get into the mix, you're just like, wow, there's a lot of people, including myself, that are just they're just living in the moment, and they will make horrible financial choices, and not save for retirement, not invest because it's riskier, painful at the moment. And I mean, I guess I sound like a broken record all the time, but I did not think, like I said 3 years ago, that when I think over 75% had interest rates under 3% or under 4%. I didn't think that people would just give that up. But I forgot that adults, most of them in America, are not good with money. And I think it's, you'll probably see that number go to 25% in just a few years.
Yeah. It's unfortunate because it's like the opportunity of, a once in a generation or a couple generation lifetime to lock something like that up, but then it's squandered away based on
same word I was going to use.
These micro decisions because of poor financial literacy. It's unfortunate, but it is something I see all the time.
Yeah, I have poor spending habits too. But fortunately, I just make a lot of money.
Yeah, just make more money. Yeah.
I used to be really, really good with my. I guess I'm pretty good with my money because I have passive income. I buy rentals, and most of the money I spend on investments and stuff. I'm just very poor with having a lot of cash in the bank. I just like to spend it all.
Yeah. Use it, and lose it.
Yeah.
You never know.
But
I'm glad to finally get to taste the Smurf juice.
Yeah.
I'm here.
A lot of people comment on the blue drinks. They're like, what is that blue stuff you guys drink?
Yeah, I'm surprised it's legal.
Are you feeling it?
No, not yet.
Okay. Why don't you feel this? You want to take a little sniffy of the smelling salts? Yeah,
we'll clear out these sinuses here.
Let's do it.
Oh, it's double wrapped. That's
take a little sniff of that.
You're supposed to like loft it in, right? You don't just want to barrel into the.
Just go. You don't think about it too much. It's like just dive in like a swimming pool. Brett took his. For those listening on audio, he is questioning his life choices right now.
Woo! That was fantastic. That's fantastic.
Oh yeah, that went in my mouth.
Man, Yeah, I
That
took
one
way too
straight.
big of a
That's in my head.
inhale. Wow.
Isn't that great?
I'm ready to go. Let's go. Let's talk about this scam of now that are you already under contract with your
Uh,
development?
we need to
Can I
sign it. We got a contract yesterday that we have to review as partners, but it looked pretty doable.
I guess.
But yeah, we can talk a little bit about it. Just no names or numbers yet.
I wasn't going to talk about it. I was just going to torch builder financing.
Oh, okay. Go ahead.
But I don't want to ruin your deal here.
No, you're not. No one's listening.
Oh, okay. Fair enough.
Okay, it's kicking in.
Oh,
Man,
yeah,
I feel good.
We're locked in now. Oh,
We're on pre-workouts and smelling salts, and we're just sitting in a shed in the backyard talking on mics. Very appropriate.
builder financing.
Uh-huh.
This is something that I run into a lot.
Tell me about it.
So you like when you go and you look at new construction and they're like, hey, 4.99% financing.
Yeah, it sounds attractive.
And you're like, wow, this is cool.
Uh-huh.
How do they do that?
They charge you a little bit more for the house, and then they buy the rate down, right?
That's exactly right. And there's
Yes.
nothing.
So you're still paying for it in the long run, but it is actually. I mean, I don't think it's a bad thing to have a lower payment.
It's super clever.
It's very clever.
Yeah.
Well, these builders know what they're doing.
Believe it or not.
They don't
Yeah.
build product to just sit there and scratch their head.
Yeah.
They know how to build the right type of house and for the right neighborhood, for the right type of person at the right price, and they can manipulate the interest rate.
Yeah.
To compete really well
Mhm.
with the resale market. And I think the local builders here, anyway, most of them do a really good job.
They do a good job, and most of them, if I call them and say, hey, can I get the same lender credit that you're offering your in-house lender to buy down the rate, then they're like, yeah, sure.
Oh, really?
Yeah, which I appreciate because then it doesn't shaft me. But you go to like one of the bigger, more national names,
Yeah,
who have their own kind
their
of in-house
own lenders.
Yeah, they're like, no, pound sand.
So just give us a ballpark for where those builders, they can like give you a teaser rate, which they can make happen, right?
Yeah, that's legit.
Where they can drop the rate almost a full percentage, right? Or sometimes even more. How much does it cost on average? You know, like a $500,000 mortgage or house. How much builder credit do you need, or how much of a seller credit do you need to buy down the rate by almost a full point?
Quite a bit. It's going to vary based on a bunch of factors. I can give you kind of a real life scenario right now.
Yeah, please.
Of somebody who's using seller credit to buy down a full percent on the interest rate. It's essentially 3 points, so 3% of the loan amount. This particular person's got a $570,000 loan amount, so it's like 19 grand is what it costs to buy down 1 full percent interest. So I would say roughly it's going to be between 2.5 to 3.5 points to get 1% in savings off the interest rate. And so if you're looking like if the builder is selling a $500,000 house, to keep the math simple, they're probably baking in somewhere between 12 and 18,000 to use towards financing for a teaser rate.
Okay. Gotcha. Now can you, in your head, I know you're not a calculator, but can you kind of give us a rough idea? What is the difference between financing, an extra $18,000 in that scenario, for like the payment amount, versus how much does it save you? You know what I mean by that?
No.
Okay. So, so obviously if you're getting a loan, and you're financing an extra 20 grand on top of your mortgage loan over 30 years, approximately how much does that move your payment up in relation to, a 6% interest rate down to a 5% interest rate?
Oh,
that's what I'm trying to be like. Is it worth the squeeze?
Well, in the
Long term.
So there's two parts to that. The first part, in a builder scenario, the builder doesn't want to drop the price, because if they drop the price on this house, they have to drop the price on the next house,
Yeah.
or it's going to affect their, appraisals or whatnot. So so the treaty a builder's a little bit different than a seller. A seller, at the end of the day, my net is my net. A builder is they want the top line price to be the top line price because they have other factors to consider.
Right. They have other houses to sell, and they don't want to ruin the comps, because that's how their values are brought into, like, it's based off what other homes they're selling for.
Right.
And that's how they get their values. So so it does, unlike a regular seller, just like you're saying, they don't care
Right.
what they're doing to the comps.
Yeah,
The builder cares about that extra factor.
Exactly. Now, to your question, like, what's the trade-off of buying down your rate? I mean, it's math. There's a break even. Buying down 1% from the par rate, which is the rate that you don't have to pay for. So if average interest rate today is 6% that you don't have to pay for, so that's the market rate.
Yeah.
It's the par rate, $0. Buying down 5% to 5%. That's a long ways. The farther you go from the par rate, the more expensive it is. So going
Sure.
from 6 to 5.875, it's going to cost some money, but it's not the same amount of money as going from 5.125 to 5%, because you're farther from the par rate. So it gets exponentially more expensive the farther you go from the market rate.
Yeah. Can you buy it down to 0?
The lowest rate sheet I have right now is like 4.25.
Oh, okay.
And
You can buy it down to almost 2 points.
Yeah, you're looking at like 6.5% in points. Like, it's a crazy amount of money.
Okay.
When determining like whether or not you should do it, it all comes down to the break even.
Yeah. How many years do you have to have the mortgage for it to make sense?
Right. I'm like, everybody's got a different philosophy. I like to break even in less than 18 months. If you're not breaking even in less than 18 months, I wouldn't do it.
Yeah.
Some people say 3 years.
Most people are in and out of a mortgage every what? You probably know this. Is it like 4 to 5 years?
It's hard to get reliable data now because COVID kind of screwed everything up.
Oh, how so?
Well, basically everybody in the country refinanced in 2020 and 2021.
Oh, that's true.
So
even if they just had their mortgage for a year or two. Yeah.
So
that's right. The data's skewed now.
It's I see anything anywhere from 3 years to 8 years, and so it's too unreliable. But generally speaking, people refinance their mortgage. People move. I mean, you might know, how often do people move? We think this is our forever home until it's not.
The historical data before COVID was every 5 to 7 years. People are typically moving.
And so we go into these 30-year loans thinking it's a 30-year loan.
Yeah, and it's not. For most people.
Never is it actually 30 years. If you stay in the house forever, odds are you're going to refinance. You might refinance to a 15-year mortgage. You might decide to pay it off early. There's just so many things that come up that amortizing it over 30 years and comparing the savings against this rate versus this rate over 30 years is just not practical. I don't think it's realistic.
Yeah.
And so making decisions based off how much interest I'm going to save 30 years from now on this loan versus this loan, it's true. But in reality, this is just not what most people do. And so, yeah, I mean, what I look for is breaking even in less than 18 months. Sometimes there's other reasons to buy down points, though. I have certain people who, I'm not going to sleep well if my payment's a penny over $2,500 a month, for example.
Yeah.
And so I'm willing to pay as much money as I can to just get it under $2,500.
They're going to be upset in a year or two when their escrow adjusts.
Exactly.
Taxes and insurance can go up, and that can.
And they almost always go up.
Yeah. They rarely go down. Sometimes they go down.
Taxes in Idaho go down sometimes.
Once in a while, that happens.
I was surprised to see that.
I remember my mortgage went down once. I was like, "How did this happen? This is awesome."
Yeah, I feel like insurance is not going down though.
It hasn't lately.
Yeah,
it's been a little brutal. Insurance companies are like, "We want money now. Lots of it from everyone."
Yeah,
and they deserve it.
Do they?
No, I don't know.
I feel like what's that guy who shot the insurance executive? I feel like he didn't think they
That was a
deserved it.
health insurance executive.
That's true.
Yeah.
So property and casualty were
Luigi Mangione or something.
we're okay with property and casualty. It's just those life and health guys.
That's so sad. Maybe not.
Yeah,
I don't know.
it's
I just don't think you should shoot people.
not in America.
Not in America. But you should overseas.
No.
Is that what you're saying?
No, I'm not saying that either.
Taking a dark turn. So interest rates.
Yeah. What were we talking about?
We were talking about
18-month. Yeah, if you're not breaking it,
if you're not breaking life.
it's a math decision. But what I tell people is like 18 months. We don't know where you're going to be in 3 years. I don't know where the market's going to be in 3 years. You might have a new job. You might have moved somewhere. You might have had a couple more kids, and you need a bigger house. Like there's so many things that come into play.
Yeah,
like
your life changes every 5 to 7 years. So it's not just your people decide they want to move every 5 to 7 years. Just like people's lives tend to change every 5 to 7 years. People get bored, they do new things, or things happen to them. So like what you're saying, just actually having the mortgage and not changing it and living somewhere for 30 years is so extremely rare. Is there any data on how many people, what is the percentage of people that get a loan and they take it to the end of 30 years?
I'm sure there is data. I don't have it.
I'm going to look it up.
Yeah.
While you're talking, if you don't mind.
You're a Grok guy, aren't you?
I am a Grok guy.
I just switched to Claude.
Claude's pretty cool.
Yeah, I switched from ChatGPT because they're the devil now that they're willing to deploy autonomous weapons around the country.
Are they really?
Did you?
I saw that Anthropic didn't want to do that. I didn't know that like OpenAI just stepped right in.
Oh yeah, they're like, hey, we'll sacrifice our morals.
Did you know OpenAI was actually like originally funded by Elon Musk, and it was supposed to be an open source?
Yeah.
Open source
AI
nonprofit.
Yeah.
And then as soon as Sam Altman noticed that Elon had his back turned, he just like, thanks for the $50 million. Now it's for profit. You're not included. And it's closed source.
Yeah.
Amazing.
Yeah. I was okay. I was okay with that until I wasn't,
Yeah. Anyway, now I have to log in to Grok for some reason. I'll get there here in a second. So, what's been the most interesting loan, if you don't mind, little side story that you put together this year? Any good stories? Because I remember last year we worked on a deal together where you just almost quit.
Oh yeah.
Yeah.
What? Yeah, our mutual client. Yeah, that was a tough one. Pretty much. Geez, I don't know. Interesting loan. I saved a loan in December for a real estate agent. I don't know that it's super interesting, but some people might not know that you can do it. Agent texted me like the day before closing. Hey, just got the heads up. We're not closing tomorrow.
Oh, great.
Why? What's the problem? I don't even remember what the problem. Oh, they were trying to do like a manual underwrite. They didn't have enough income. So I look at the deal, look at the property. The loan officer who was doing that loan didn't include the ADU income from the ADU in the backyard. And so they got denied due to insufficient income. But when I looked at the appraisal, I'm like, dude, there's an ADU in the backyard. Why aren't we using that income? And you can use ADU income if roommates are if one roommate's buying a house and your roommate's coming with you and you have a history of them paying you rent. You can use that. It's called border income to qualify for a house. You can use, if you're buying multifamily, you can use the rent from the other units to boost your income to buy a house. There's a lot of ways to use outside income to help you qualify either to buy a house or to buy a more expensive house than just what do you make.
Right.
That's always interesting.
So we got the data. People that actually take their 30-year loan all the way, between 10 and 20%.
It's more than I thought.
It's more than I thought, but it's still very low.
Yeah.
So odds are never, well,
Yeah.
not never, but like 80% of people or more than 80%, um, will eventually refinance or sell their house.
Mhm.
It's interesting.
I
So
I just did a loan for an 82-year-old, 30-year loan.
really,
Yeah, I don't think they're gonna be
they might,
taking it for
well,
30
somebody
years.
could just take it over sub two, right? Like a child or
Yeah,
something.
yeah.
Yeah. Do you ever hear of that happening much where if an elderly person, if they're, they die in their houses, they still have a mortgage going, can somebody else just step in and start taking that payment over?
Like sub 2 or like heirs?
Like sub two or like, is there a process to that?
Yeah, I mean, I don't see a ton of like the sub 2 side because they're not trying to get a lender involved in that.
Yeah.
Sometimes I help people understand the rules and the guidelines, because one of the things with sub 2 is the people who are moving out of the house, or maybe they're staying in the house or whatever, they a lot of times they're concerned about not being able to buy another house in the future because this is still counting against them. And so I help talk people through that on occasion, how the rules for that work when your debt's paid by another person and you can document that, it's not counted against you.
Okay.
Um, but yeah, I don't see a ton of like sub 2 stuff. Hey,
Yeah, you probably wouldn't.
I'm struggling with something, and I want you to
Let's run through it. What's going on?
okay. So I've taken a turn on creative finance. Okay, now anytime I hear the word creative finance,
Uh
I mentally associate it with don't have any money.
huh.
And I need you to kind
Fair.
of talk me off the ledge here.
No, you're right. You're right. It's people that don't have money, or credit,
Fair
or
enough.
know what they're doing.
Okay.
I'm joking. That's most of them, but there are some people that it's just a savvy tool in their pocket if it makes sense at that time for that situation.
Right.
So I've done the sub two route, or
Mhm.
um, I've done that probably 8 times or something. Hey, quick commercial break here. Thank you so much for listening to this podcast. I really do appreciate it. If you want to give back, let me help you buy a house, or I can help you sell a house. It's the only way I make money when I'm not investing in real estate. I don't make money on this podcast or the events I do, but I do make money only when I help people buy and sell houses. So if you're looking for your next investment and you're here in North Idaho, I want to help you personally. If you are not in North Idaho, I can still help you out. I have a vast network of referral partners all across the country, and I can find the right real estate investor savvy agent for you so you don't have to. It doesn't cost you a thing. Thank you for your support. Back to the show. Purchase that way. And then I've even sold a couple times on sub two because it made sense for the situation. But most of the time it's like, if you're dealing with somebody where they don't have a lot of equity, it's a distressed situation. Maybe they're about to lose their home, but they have a pretty low payment
Mhm.
and they're comfortable with somebody taking over payments for them and taking control of the house and buying the house without paying off that loan and leaving their name on there, and they know what's actually happening. That's explained to them. And the title company is willing to work with you too on this. I think it could be a great tactic for just not originating a new loan for somebody. Even if somebody has money, it should be people that do have the money and the means and resources to buy these, so that if a loan is called due, or if something happens, or if they start complaining that, hey, I didn't, I'm trying to get a new mortgage and this is still on my credit and it's been less than a year. Can you do something about it? Maybe this person has the means to just sell the property or refinance or figure something else out.
Mhm.
But I do, for the people that really seriously just don't have any money, very little experience, low resources, just taking somebody's mortgage over subject to, is pretty risky for all parties, I think.
Yeah.
Um, just because I think it's definitely a more advanced strategy,
Mhm.
even though it seems so simple.
Yeah.
But it comes with a lot of baggage that people don't talk about. Dealing with the
Risk.
insurance,
Oh, yeah.
dealing with insurance long term with people, dealing with other people's names being on your mortgage, dealing with like, okay, who's getting the tax, you know, uh, the who's getting the tax benefits for paying the interest on the loans, and figuring all that long term with somebody that 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 you can be in communication with the seller for another 20 years
Yeah. Yeah.
easily if you actually are trying to do this method. um and to make it even worse, if you're just wholesaling stuff like this, where you're not the person that's buying the property is taking over something sub 2, and you're just in the middle trying to string these people together, and the seller has no idea who's buying their house. They never met them, and they're just taking over their mortgage
Yeah.
and being
Yeah.
and not necessarily responsible for the mortgage. So now they don't. And the reality is, when you sell to somebody on sub 2, you do sell them the house, and you are still responsible for the mortgage.
Yeah. So there's like a level of trust.
That's it. So you have to have a high level of trust
Yeah.
with whoever's buying your house. And there's these Facebook groups everywhere where people are just wholesaling sub 2 deals to strangers. And I just don't see it going well long term, because it's a very long term strategic, a lot of moving pieces. It's simple. The problem is it's simple to jump into, but it's very complicated to sustain long term.
I think that's the thing that I see. It's marketed as like a very low burden of entry in terms of cost, but it's very high burden of risk and responsibility.
Yeah,
And
long term.
Yeah.
Tyler and I bought a property on sub 2 in 2019. That was 7 years ago. We still once in a while have to communicate with the seller.
Yeah.
It's a really low interest rate, and it was a 40-year loan when we got it. Yeah. So we might have to be in this.
To go.
This person might die before we do, and we're gonna have issues with it. But it's a great long-term rental. It's a low payment. Mm-hmm. We just had to re-rent it. I just put it out on Facebook where we had like 4 people look at it for $2,500 a month. Our mortgage payment is $1,300, and we bought it with $15,000 down.
Yeah, that's cool.
And we put a little bit of work into it, and it wasn't a really old house. It was nice, but pretty complicated to stay in touch with somebody who was in distress.
Yeah,
7 years ago.
Yeah, yeah.
And and the loan is still in their name. The lender has never approved us, and the lender has sold the loan multiple times. So we're dealing with new lenders all the time, and the insurance has always been a mess. I mean, it's somewhat clean right now, but it's always a sticky situation with underwriters. So easy to jump into, but hard to steer the ship long term.
Would you say, because I see a lot of people who try and get their start in investing in, I shouldn't say I see a lot of people, I see some people try and get their start in investing through creative finance. I feel like wholesaling would be a much better use of, like, find the deal and any legitimate investor will buy it. Don't be wasting time trying to find some super creative thing that you don't have the experience or reputation to manage.
Yeah. I guess I have mixed feelings about that, because one of the first deals I bought was creative financing, a seller financing deal.
An idiot.
And we didn't have much money at the time, but we were able to structure a deal. This was like 2014. But we bought a house in Rathdrum for $40,000. And we needed $3,000 down to pay off the real estate agent. And then we were making her payments of $300 a month. But we didn't have the money to fix up the house. We had to flip another house, our first house, to make the money to come back to this other house.
How'd you buy it?
We bought it on seller financing.
Oh, okay.
Seller financing.
Is that considered creative financing?
Yeah. So seller financing is considered creative financing.
Wow.
So it's, the subject to seller financing, land contracts, those are all kind of in the same LGBT bag of, of, loan ways to ways to creatively get a product
Oh, well,
through the door.
I retract my, because if you can lock seller financing, especially in
Yeah.
some of these 2020, 2021 loans, I mean,
Yeah.
slam dunk.
So I bought some land in St. Mary's or over the summer on a 30-year loan with a lady, and I had a 5% interest rate and $2,000 down, and it was kind of discounted too at that price. So for 20 acres, I'm making a $1,000 a month payment. I have a
Yeah.
180 something $1,000 loan. It's on a land contract, so it's what that means is like it's the title never changed completely to me. It's still in her name, but we're in a contract for deed, which once that loan's paid off, then it will be transferred in my name. And it's still legally set up. There's still an escrow company taking payments. I'm not making payments directly to her. And I have, essentially like a recorded lien against the property showing that I'm purchasing it. And the IRS sees it as I'm buying that property, and the interest that I'm paying is deductible. So that's a creative, that's in the LGBT bag of, of creative ways to put a deal together. It's probably a very inappropriate way to talk about creative loans. I don't know.
Let me ask you this: in your experience, when you're walking through a house that you're considering purchasing to flip, how long does it take you to make a decision?
4 minutes.
That's my thought.
Yeah.
My personality is that I like to do an exorbitant amount of analysis to the point that I talk myself in or out of a deal. But it seems like in talking with you and other people, it's like, it takes me 5 minutes. Like this is probably going to be 50 grand because every rehab's 50 grand, and it's probably worth, 475 to 500 when I'm done. It might be worth 508. It might be worth 460, but I don't need to get into all the nitty gritty right now. Yes or no.
Yeah, but I can only say 5 minutes just because I have 10 years of experience flipping houses in this area. So and I've been a real estate agent for 15 years. So I have a lot of presets already, I've already got a lot of programmed into me on how, and an algorithm in my head of how to make a decision pretty quickly based off the presets I've set, that I'm comfortable doing certain deals and not others. So that's why it only takes me a few minutes to be like, oh yeah, let's do this. And also with the, not being 100% on board because there's might still be an inspection involved, but I can at least say, yeah, let's make an offer within a few minutes and know how much that offer should be. And we'll probably be accurate on our ARV by, 5% or so, depending on where it is and all that stuff. But
you're a 70% ARV guy?
Depends on where it is.
Okay.
So a lot of the flips I do are just outside the county. So that is
manufactured home. I know you love those, and and northern Idaho.
So that 70% goes down. I will still consider it. I just, I've taken so many punches by manufactured homes, but I've also, I remember once I made like 160 grand on a manufactured home in Post Falls.
Really?
Yeah. And it was a simple, it was a manufactured home, not classified as real property, but on real land. And it just needed the title destroyed, and it needed an engineer report.
Oh, so you turned it into real property.
And it just needed a vapor barrier in the crawl space, and that was it to qualify. So we bought a house for like 100 grand, and we put less than $2,000 worth of work into it, cleaned it up too, and then resold it and made like 160-ish net. That was a pretty good manufactured home.
Yeah.
But I flipped another manufactured home too once and lost $210,000.
Was this the one that was manufactured in 1976?
Yes. Yeah. So my algorithm, when I hear oh, there's a manufactured home available, immediately I'm like, red flags go off in my head, and I'm like, it's just a no, but I'll take a look. It's just a no, like by default, but I'll still take a look just because I know they're dependent on the price. If it's like insanely cheap, that fixes a lot of problems.
Have you talked about the 1976 manufactured home on the pod before?
Oh yeah, we
Oh,
brought it
okay.
up a few times. I mean, we've done hundreds of episodes now, so we talk about things over and over again. But
Basically,
yes, I brought it up.
1976 was the year that HUD started certifying manufactured homes,
Yeah.
so that you could get traditional financing on them.
Yep.
You bought a 1976 manufactured home
That was built to the HUD standards.
that was built to the HUD standards, but it just happened to have been placed?
It happened to have been manufactured 3 months prior to the rule kicking in.
Okay.
So even though it was built to the HUD standards in anticipations of the rules kicking in, because it wasn't built on or after that date in the summer of 1976, it was built in March. All of a sudden, the value was like 150 grand less.
Yeah.
And lost a lot.
Because it's much more, much.
And it was harder to sell.
So
and manufactured homes are just tougher to sell.
Mm-hmm.
A lot of people don't want them. And a lot of people have a hard time qualifying for average rates on them because the rates tend to be higher,
Mm-hmm.
and they just come with baggage, extra inspection reports to be done by engineers. And, they are also seen as vehicles here and there because that's how they start off.
Yeah.
But yeah, tell us more.
Well, no, I mean, you pretty much covered it. Yeah, once something becomes financeable for traditional financing, whether it's a pre-summer 1976 home, which I'd never even thought of until that happened to you.
Yeah.
Because in my head, I have the similar algorithm. Like, is this 1976? Okay.
Yep.
And then I have a couple other things that I go through for the lending side.
When I was doing my due diligence on that property, it was a concern. And I talked to David Barden about it. And he's like, yeah, it should be fine. Because I had an old appraisal report that showed that it was built to the HUD standards. And I had that, and I brought it to another. It wasn't just David. Brought it to another lender a second, just for extra. Like, is this going to refinance fine?
Mm-hmm.
And that lender too said, yeah, it's going to be fine. And then when we actually did finally fix it up, and we went to go resell it, we did have a buyer at a decent, okay price. We weren't making much, but we actually finally got it. It was hard to sell because the market turned.
Yeah.
And then that lender too was like, yeah, it should be fine. And then it wasn't, because when they went through, final underwriting, they're like, wait, where's the data plate?
Yeah, where's the HUD plate?
Where's the HUD plate? Mm-hmm. We don't know. Maybe it got remodeled. Maybe it's gone. Well, let's order a new one. There wasn't one. Wait, it was built in March, but it was built to the HUD standards. We don't care. It wasn't built to that date, so go F yourself.
Yeah.
This doesn't qualify. This is a pre-HUD home. And it was a real gut punch. So I'm like, okay, I guess we'll discount the property a little bit. And then I had to discount it again and again and again for many months until I had, I bought it for $400. I bought it on a high leverage hard money loan that accumulated, $4,000 of interest a month. And we put like almost $80,000 into the remodel. And then it took a year and a half, or took like a year to sell it. And then I sold it for $350 cash. And I had to give all the staging furniture away to make the deal work. And took on the front end, I took like a $210,000 loss.
Oh.
But I didn't have enough cash to come to closing. I needed to get a loan for $117,000.
Oh, that stinks.
And I had that loan for a year too, making like $1,100 payments for a year, interest only, until I came up with enough cash to pay that off. So I lost, over 225 or something like that overall.
Investing is easy.
Investing's easy though. Everyone should do it.
Just buy and make money.
Yeah. But fortunately, I'm in real estate and I was able to fix the problem over time. It was just very painful. Like, it's not fun losing that kind of money and doing all the work.
Oh yeah.
Yeah.
Yeah. The
And having partners that just got to walk away.
but it sounds
Yeah.
like there are opportunities out there, at least one that you found where a manufactured home right now is the way that it's registered with the county is it's a vehicle parked on land, but
Yeah.
it's got everything that it needs to be affixed to the property and become real property. And by doing that, it's
Well, it already
value.
was, just nobody finished the process. And
Okay.
and the owner at the time didn't really know, or didn't care. And and then she just got ripped off by the wholesaler that
Oh no. Yeah.
brought,
Yeah. Brought you the deal.
brought the deal. I mean, but she was fine with it. I think she bought it for less, obviously, a long time ago. But that's how you get these deals. You rip off sellers.
That's all of real estate, isn't it?
That's the hard part about when you say, oh, they should just go be wholesalers, these new people. Are you prepared to just go rip people off?
Well,
I'm just joking. No,
As far as
I'm
I
joking.
heard,
I'm exaggerating. No.
wholesaling is wholesome, and we're only helping people in distress with no other option.
And that is true sometimes. But most of the time people are just getting ripped off. And that's just the way it is. Right?
I'm not making any friends right now.
I know, but that's just the way it is. And they understand they're getting ripped off. It's just like when you go to a car dealer and you're trading in your car, they have to rip you off to make money.
Yeah.
Otherwise, they're just going to break even and they're going to shut their car dealership down. So you have to buy at a discount, and the seller has to understand. Sometimes they don't know, though. They don't know how badly they're getting squeezed or how much more that they could make if they just like tried a little bit harder. But it is true. A lot of these people, it's just like if you're wholesaling your house, you just don't care about it as much as like when people like have an old car and they go to a dealership and they know they're selling at a huge discount and they know they can probably make a lot more if they just cleaned it up and put it on Craigslist. They just don't want to deal with it. There are those people out there and they sell to wholesalers. So I don't know if it's unethical. Sometimes it can be.
Yeah.
I think most of the time it's not. Because I think most of the time they do understand they're selling at a discount and they're in a distressed situation and they know there's dog shit everywhere in their house and it's just they're not going to do anything about it. But sometimes sellers are just getting ripped off.
Yeah. Yeah.
And that's where I step in to buy it later. I just can't do that initial ripping somebody off. I just want to be able to sleep with myself. So that's why I'm not a wholesaler.
Fair enough.
Yeah. Hot take.
Yeah. Oh, that's good. It sounds.
How do you feel about that?
Wholesaling?
Just what I said in general. Is that a little too brutal?
No, I think. I mean, just like anything, there's gonna be good and bad people who are looking to help people and looking to exploit people, and in that case, there's the line is somewhere, and do I have the right if my parents die in another state and I don't want to deal, it's too emotionally traumatic, or I don't want to deal with it, can I just can I knowingly sell it to a wholesaler at 70% or 60% of the ARV because I don't want to deal with it anymore? Like, yeah, I should have the right to do that.
Yeah, of course.
But, that would be, I wouldn't take moral issue with that. But then obviously there's circumstances where people come in or they're a smooth talker and they talk somebody who's in a distressed situation is looking for help, and they talk them into wholesaling their property when there are other avenues that they could have taken to not lose their house or lose the equity in their house, etc.
But again, I will say I don't want to distort reality here. Most of the properties I buy as fix and flips from wholesalers, it was probably that seller's best opportunity at that time to just deal with that because they weren't going to do anything on their own.
Sure.
They're just those kind of people that just are not going to do what it takes to sell a house, and they're just going to click the easy button. So you do kind of need, I don't know if you need wholesalers, but because flippers can do this too. They can go buy at discounts too, but it does make the whole process a little bit easier. But there are instances where it's just like, gosh, that sucks. Like there's this guy that a bunch of people here in the investor group follow that's like, shows that he's like out of Boise and Phoenix, like Char. I think his name is like Char Taring or something like that. I forgot his last name, but um, his business model is to rip people off. Not even like, and this just happened. If you talk to Corey Trent, he just bought a property, and the seller had to pay off a wholesaler because his business model is to target people, potential motivated sellers or people that might get foreclosed on soon, and just sweet talk them into just get them under contract at whatever price, and then record that contract with the local county, and then abandon, and then just completely wait until it's too late. And just, they wait until somebody else is trying to buy it, and then they have to get paid off to release that lien or what they recorded against the property. So this guy he got a $30,000 fee, and he's just conning people legally. And he's like an influencer. He's a real estate influencer that people like. A lot of people in our community follow him.
So hold on.
And he's done. And no, get this. Hold on. One more layer to this. The title person or somebody in that sphere that knows about this person said, yeah, he's got like 50 of these around the country right now. This is what he does. I mean, he talks about like flipping. He buys houses and flips houses too, but his main strategy is just ripping people off, conning people into paying them cancellation fees.
So he intentionally locks up a deal at some price that he has no intent of actually purchasing it at.
Yes.
And then waits for another wholesaler or investor to come and want to buy it, and then takes an assignment fee in the middle.
No, he will force the seller to give him money at closing to be willing to release the lien. Otherwise, the seller has to sue him to release that contract that they recorded against the property, which the sellers just don't, especially if they're in that situation, they don't have the time to deal with it legally. They have to pay him off something, because otherwise it'll just go to foreclosure.
Oh, wait, that's why he's waiting.
Yeah. Yeah.
Well, the American dream.
Yeah. This guy's an influencer that people in our sphere follow. And he's like a terrorist. Like somebody that should be doing this, from overseas, like in Russia or like, Nicaragua or whatever that place is called, Nigeria. That's where all the scams come. Yeah. But this guy's like local, and he's doing this around the country, just scamming sellers at a high level, just agreeing to whatever purchase price that they want, just to get it under contract, and then paying somebody on TaskRabbit to go record that contract with the county. And then they have to deal with that in order to close on their house. And that's his tactic. And he's such an asshole about it too. But on Facebook, he's a lovely person.
Yeah. Well,
yeah,
that's typically how it goes.
It's just interesting. Also, I think wholesaling is going to become illegal from people like that.
Well, yeah, that's definitely doesn't have people's best interests in mind.
Yeah. Yeah. No aligned interest there. It's just people just trying to take.
Yeah.
Yeah.
Well, what else, dude?
I don't know, man. Let's see. How are we doing on time here? Oh, it's been an hour. You got it. Well, that's all I got. I just wanted to talk to you. It's been a while. It's your third time on, I think.
Yeah, you're welcome.
Thank you. Appreciate it. You've been a great co-host.
Yeah, we miss you, Jeremy. I doubt Jeremy got this far.
Nobody listens this far.
No.
You should see the statistics. It's bad. I'm just kidding. Yeah, a few. All right. Well, thanks for listening, everybody. Thank you, Brett, for being here. Sorry we went down a dark turn here and there and talked about the war and scammy wholesalers when we just wanted to talk about your business. Shout out. What's your business name again? You
Kingdom
started your own
Mortgage.
King Mortgage?
Kingdom
Mortgage. And this is your own brokerage, right?
Yes.
Tell us, what was it like starting that?
It was easier than I thought, and I was also harder than I thought. Being a broker, like the beauty of the brokers, I work with a bunch of lenders. And
Yeah.
so I'd already figured out who I want to work with, the lenders I want to work with. I'd gotten all that in place. And so the transition was super smooth. But then there's just like the practical stuff of running your own brokerage. For example, I didn't know, don't judge me, I didn't know that your brokerage has to be separately licensed to originate VA loans.
Okay.
No idea until I
Ran into
3
that.
weeks in trying to do a VA loan. They're like, you're not licensed. I'm like, what are you talking about?
I am licensed.
And so thankfully that was right in the middle of that 30-day government shutdown.
Oh, okay.
So it took me about 6 weeks to get licensed with the VA.
Thankfully, as in you're sarcastic about thankfully?
Yeah, that was super
Okay.
super unfortunate for me. I had to pass my client off to another trusted
Oh, dang
lender. But they took great care of him. So and then that lender appreciate it.
Yeah. When you have to do something like that, do you usually get a little taste still?
No, that would be illegal.
Really?
Yeah.
You can't refer loans
Mm-mm.
and make. How come real estate agents can do it?
Because they don't mind committing crimes.
It's true.
That would
Let's
be
end with that.
a RESPA violation, which you probably haven't heard since you got licensed 15 years ago.
I've heard of RESPA.
Oh, okay. Well,
Yeah.
We're not supposed to pay anything of value for referrals.
Okay.
And so agents who are getting paid typically are in the gray area of becoming some sort of employee of the lender. And so they're not acting, they're acting in like a dual capacity in that sense. And so they're getting some sort of cut as an employee of the lender, not as a referral fee for sending a client.
Okay.
And so it's a gray area. I'm completely okay with some gray areas. That's not one I'm going to dabble in.
Okay.
Yeah.
Real quick before you go, what kind of loans can you do?
Everything long term. So I don't do hard money. I don't fix and flip. None of that. But anything people want to have a loan for basically a year or longer.
Okay.
And qualification wise, we do everything from the normal stuff that everyday people use to bank statements, P&L loans, DSCR loans, where we look at just the performance of the property, not your income.
So what you mean by that, like if you are self-employed and you make dog shit on your taxes, but you actually do bring in money into your bank account, you can use it. If that person has okay credit, you can still probably get them a house.
Yeah. Credit's always going to be important for long-term investing, institutional investing. But income, we can document a lot of different ways. Bank statements, the most common, last 12 months of business or personal bank statements, look at the deposits, that's your income.
Okay.
But some circumstances you might do something different, like a P&L. I've done like a couple home builders who they're custom home builders. I only have 2 deposits in the last year. They were for $600,000 a piece. Well, that creates like a consistency and reliability issue. But if we just look at your P&L that's signed by your CPA, that tells us everything we need to know for your income. And so there's a bunch of different ways to calculate income that don't look at W-2s, pay stubs, tax returns, etc.
Okay.
Yeah.
Right on. Anything else you want to say before we go?
I don't think so.
Okay. Well, thank you, everybody. We'll see you next week. Have a great day. Bye. I don't think so.
Thank you so much for checking out the Investor Shed podcast. If you enjoyed your time, make sure to leave a 5-star rating and review on Apple Podcasts and Spotify. Follow along on YouTube, TikTok, and Instagram at The Investor Shed for shorts and promos about each episode. Do you want to be a guest or know someone who has great real estate investing advice and stories? Reach out to us at theinvestorshed@gmail.com.